Good morning, Miss. I'm Pramila and my partner will be Tanisha. We are presenting our final project. The company we chosen is Parini Holdings Berhad and Astrom Asia Holdings Berhad. So moving to the introduction. So the company background of the Parini Holdings Berhad is it's founded in 1971 and started out as a producer and distributor of clothing. The main focus of Parini operation is in creating, producing and selling fashion clothing, shoes and accessories. Padini is active in their fashion and sector which is categorized by their fierce competition and constant changes influenced by their evolving consumer tastes and their fashion trends on their own way. Their mission and vision is affordable quality fashion aims for their sustainability and their market expansions. So the company development of Parini will be the digital expansion, which is the enhanced online platforms, regional growth, which is new outlets in Thailand, Indonesia, and Vietnam to reduce their local market reliance, and sustainability initiative, which is focused on the eco-friendly practices. So moving to the SWOT analysis, the strength will be diverse in house brand, which is example Vinci Seed, which catering to the multiple segments, strong local market presence with affordable and stylish products in their market, extensive retail network enhance accessibility and their brand recognition. Weakness will be the limited global market presence compared to the other retail platforms such as the H&M, Zara, Uniqlo, Cotton On. The next will be the high reliance on physical stores, uh, where e-commerce capabilities. The opportunities will be the growth potential in online platforms and digital marketing. The threats will be the intense competition from global fashion giants. And the next will be the Astrom Asia Berhad. So the company background will be found back in 1996 and soon become the number one paid television services provided in the country. As a corporation engaged in the provision of media content, business activity of Astro encompass such as industries as television broadcasting, radio services, digital media distribution, advertisement and production of various contents. So the mission and vision will be to entertain, inform and inspire the seamless traditional and digital services to current generation. So the company development will be the AstroGo, which is enhanced interface and features for on-demand content. Global Alliance, which is partnered with Netflix and Disney Plus for bundle subscription. Local content focus on their diverse drama, films, and live sports. Cost optimization, reduce operating costs, streamline content lineup. Go Shop growth, which is expanded product range and online presence. So the SWOT analysis will be the strength, market leader in Malaysia's media sector with strong brand awareness, loyal customer base and robust online presence, which is AstroGo global streaming collaboration. The weakness will be the heavy reliance on paid TV, aimed to pay TV, high subscription costs, and the limited global presence. The opportunities will be the rising demand for their digital content and streaming services, potential for global partnership and local content creation. The threats will be the intense competition for global streaming giants, which is Netflix, Disney Plus, Hotstar, regulatory challenges, and changing consent preference. So moving to the next part, which is the analysis of the both company. So first of all, for the Padini, the AM, which is have the positive average daily return with the 0.004, and they have a moderate variance and standard deviation, which is variance is 0.003 and standard deviation with 0.0173. Their risk and return have their reliability stable with 42.10%. So to conclude overall for the Padini, they have a secure investment choices with steady performance and limited market risk. So moving to the Astrom Asia Holdings Berhad, their performance through the 3 years will be negative trend. Their expected return, which is their AM, which is average daily losses, and their variance is higher risk than the Padini Holdings Berhad. The standard deviation of the Astromesia has the high volatility. The coefficient variation of the Astromesia have the unfavorable risk return ratio compared to the Padini's Berhad. The key insights of the conclude of the Astromesia is inefficient management of volatility, increased competition, and shifting consumer preference impact the profitability of the company. So moving to the portfolio section for both company. So expected return for Padini is have a higher return compared to the Astro have a negative returns. They are equal weights drag from the Astro's share price. So for the standard deviation, Padin has the moderate risk compared to the Astro, which is have the high volatility. It shows that diversification reduce risk initially, but increase with the higher Astro allocation. So for the required rate of return, uh, the required rate of return with higher Astro allocation due to the negative returns, their APT, which is RR, increasingly negative as Astro have the weight rises. So the last but not the least, optimal allocation, which is Padini with 60-80% and Astro 10-20% for balanced return and risk. It will minimize Astro's exposure to reduce volatility and negative impacts. So for the next part, I will pass to Tansha.
So for the company analysis, first Padini Holdings Berhad. So their profitability ratio, gross profit margin increased from 37.84% to 39.39%. So this reflect the effective cost management of Padini and efficiency of operational. So the net profit margin is increased significantly from 5.25% to 12.22%, where this indicate the Padini show the company's ability to generate strong into the liquidity ratio. Padini's liquidity ratio, the current ratio is in 2021 is 5.4% until its decline in 2023, 4.47. And the quick ratio for Padini in 2021 is 3.92, and it slightly decreased to 2.72. And for the efficiency ratio, debt to equity ratio consistently below 1, which is improving from 0.68 in 2022 and to 2023, where 0.60. So this indicates the company's company has a balanced reliance on debt and equity. So the interest coverage ratio would be improved significantly from 4.51 in 2021 to 14.61 in 2023. So this show the company has enhanced the profitability and minimal financial risk. So for the solvency ratio, inventory turnover improved from 2.93 in 2021 to 4.56 in 2022, where it's before slightly declined to 3.87 in 2023. So this indicates the effective inventory management through a closer monitoring, which is needed to sustain efficiency in upcoming years. So moving to Astro Malaysia Holdings Berhad. Their current ratio is in 2021 is 1.06, which indicates sufficient current asset to cover their liability. And in 2022 and 2023, itself increased where but both year it's remain under 1, which means they are not exceeding their current asset, threatening their short-term stability. So for their quick ratio, declined from 0.53 in 2021 to 0.41 in 2023, which reflect the increase in reliance on inventory for liquidity. So for their total asset turnover, declined from 3.80 to 3.46. So this highlights their reduced operational efficiency and lower revenue generated per unit of asset. And their gross profit margin sharp declining from 37.15% to 30.76%. And their debt equity ratio is 2.34 in 2021, and it increased to 2023. So moving to their technical analysis. For Padini Holdings Berhad, in 2021, the candlestick chart shows a strong upward trend with numerous green candlesticks indicating significant bullish sentiment. And the trading volumes search where it showcased the investor confidence as market anticipated highest sale and improved earnings for Padini following the economic downturn. So in 2022, the stock entered a phase of consolidation characterized by the fluctuation of prices within a narrow range, where COVID-19 restriction challenges like rising inflation, supply chain disruption, and geopolitical tension, which impact the market sentiment. So lower trading volumes reflect cautious and investor participations as they awaited more clarity on the economic outlook and company's performance. So in 2023, the Padini's stock price experienced a sharp uptrend where the peaking their mid-year. The company likely to adapt to well post-pandemic conditions with the factors such as improved operations, strategic initiatives, or strong earnings driving investor optimums. So the candlestick chart reflects the broader economic influence on Padini's stock performance. So showing reliance in 2021, caution in 2022, where strong growth in 2023. So this analysis highlight the importance of understanding the broad technical patterns and underlying market dynamics when evaluating the investment opportunities. So moving to Astro's candlestick chart. So for Astro, upward trend for 2021, rising by mid-year, where the rise is likely driven by a positive market sentiment and in 2022 it's have a significant downtrend. As I mentioned before, it's due to the COVID-19 pandemic. And in 2023, the bearish momentum intensified because after the post-pandemic, the Astro Malaysia Holdings Berhad's 70% decline from its peak in 2020 compared to 2021. So in this 3-year analysis, weak stock performance for Astro is due to the macroeconomic challenges, negative investor sentiments. So for now, the investors should approach this stock cautiously, monitoring technical indicators and any signs for stabilization or recovery that closely. So for the next recommendation, for recommendation, so for recommendation, the company has showed consistent growth and strong financial health, which is Padini. So the equity, in return, the equity improved significantly from 6.74% uh, to 21.41% in 2023, demonstrating increasing profitability. So Padini operates with moderate risk and low volatility, so making it appealing to investors. So their focus on affordability, sustainability, and digital transformation has strengthened their market portfolio. So from technical perspective, as I mentioned earlier, the stock is bullish, which means the opportunities to buy during the market corrections. So in summary, Padini is a reliable choice for both short-term and long-term investment. Because due to their steady returns and market adaptability. So, moving to the Astro, unfortunately, this company faces significant challenges where the key financial metrics like profitability and liquidity have been declining, and the company struggles with competition from global streaming platforms and changing consumer preference. So, Astro's technical trends also reflect a bearish trajectory because with repeated resistant failures and negative sentiments among the investors, the high volatility and underperform further underscore the risk. So as a result, Astro is currently high risk investment, and I recommend avoiding it until we see the clear sign of financial market recovery. So for conclusion, to conclude, between the two companies, Padini Holdings Berhad stands out as a better investment option because its consistent financial health, moderate risk portfolio, and strong adaptability position as well for both short and long-term growth. In contrast, the Astro Malaysia Holdings Berhad faces too many challenges with high volatility and declining financial performance. So investors should prioritize Padini for steady returns and growth opportunities in retail market. So that's all from us. Thank you.